What if I told you that some of the most valuable assets in the world aren't stocks, bonds, or even tech companies? Instead, they're raw materials like gold, oil, and other commodities that power the global economy. The commodity market is massive, with over $20 trillion worth of goods traded annually, influencing everything from the price of your morning coffee to the energy bill you pay at home. Gold alone, often viewed as a safe haven asset during times of uncertainty, sees trillions in trading volume each year. Meanwhile, oil, the driving force behind transportation and industry, has its prices swayed by geopolitical events and market dynamics in ways that impact economies worldwide. But it's not just the big players like gold and oil. Did you know that silver, natural gas, and even agricultural products like wheat and corn play a pivotal role in global trade? These commodities are the silent movers behind the scenes, shaping industries and investment portfolios alike. So, what makes commodity trading so intriguing and potentially lucrative? And how do prices fluctuate with every geopolitical event, economic trend, and natural disaster? Welcome to Satoshi Finance, where we break down complex finance topics to educate and empower you on your journey to financial freedom. In this video, we're diving deep into the world of commodity trading, breaking down how it works, and why it could be one of the most exciting markets to explore. Stick around, you don't want to miss this. Commodity trading involves the buying and selling of raw materials that are essential to everyday life and the functioning of various industries. These materials, known as commodities, can be anything from precious metals like gold and silver to energy products such as oil and natural gas, as well as agricultural goods like wheat and coffee. The key appeal of commodity trading lies in its direct connection to physical assets, offering investors a hedge against inflation and economic uncertainties. Prices of commodities are highly sensitive to shifts in supply and demand, making this market dynamic and often volatile, yet full of opportunities for traders. Commodities can be broadly categorized into two types, hard and soft. Hard commodities are naturally occurring resources like metals, gold, silver, copper, and energy sources, oil, natural gas that are extracted or mined from the earth. These assets tend to be highly valued due to their scarcity and critical role in industrial processes. Soft commodities, on the other hand, are agricultural products such as wheat, corn, coffee, and livestock. These are renewable resources, often influenced by seasonal factors, weather patterns, and global demand. Traders participate in commodity exchanges like the Chicago Mercantile Exchange, CME, and the London Metal Exchange, LME, where they buy and sell contracts based on the future prices of these goods, making commodity trading one of the oldest and most fundamental forms of market exchange in the world. Gold holds a unique and pivotal role in the global economy, often considered a safe haven asset during times of financial uncertainty. As a store of value, gold has been relied upon for centuries to protect wealth from inflation, economic instability, and currency devaluation. When markets become volatile, investors tend to flock to gold because it retains value even when other investments falter. This makes gold an essential asset in portfolios, especially for those seeking to hedge against risks tied to political instability, market crashes, or rising inflation. Gold is traded in a variety of ways, including spot markets, futures contracts, and exchange-traded funds, ETFs. In the spot market, gold is bought and sold for immediate delivery, whereas futures contracts allow traders to speculate on the future price of gold. ETFs offer a more accessible route for everyday investors to gain exposure to gold without physically owning it. Several key factors influence gold prices, such as inflation, geopolitical risks, and the strength of the US dollar, since gold is priced in USD globally. Major players in the gold market include central banks, which hold large reserves, and hedge funds that actively trade gold as part of their diversified investment strategies. These big players help shape the global supply and demand dynamics, making gold one of the most actively traded commodities in the world. If you've made it this far, consider taking a moment to subscribe to our channel. Subscribing is absolutely free, and you can always change your mind. We have a wealth of financial insights and exciting discussions lined up for you. Your support not only helps us reach a broader audience, but also motivates us to continue creating high-quality content that educates and empowers viewers like you. So, hit that subscribe button, stay tuned, and join us on this journey towards financial empowerment. Thank you for being a part of our community. Oil is a cornerstone of the global economy, powering not only the energy sector, but also transportation and various industries. Its critical role as a primary energy source makes it one of the most valuable and widely traded commodities in the world. Oil fuels cars, planes, ships, and factories, and is an essential raw material in the production of chemicals, plastics, and other industrial goods. Because of its wide-reaching applications, fluctuations in oil prices have far-reaching effects, influencing everything from transportation costs to the price of consumer goods. Oil is primarily traded on spot markets and through futures contracts. In the spot market, oil is bought and sold for immediate delivery, while futures contracts, such as those for West Texas Intermediate, WTI, and Brent crude, allow traders to speculate on oil prices for future delivery dates. Several factors heavily influence oil prices, including global supply-demand dynamics, production decisions made by the Organization of the Petroleum Exporting Countries, OPEC, and geopolitical tensions in oil-producing regions. Technological advancements, especially in renewable energy, are also beginning to affect the demand for oil. The volatility of oil prices can have profound effects on the global economy. Sharp price spikes can lead to inflation and energy crises, while price drops can impact oil-dependent economies, making oil one of the most closely monitored and influential commodities in the world. In addition to gold and oil, there are several other major commodities that play critical roles in the global economy. Silver and copper, for example, are essential metals used in industries like electronics, construction, and renewable energy. Natural gas is a key energy source for heating, electricity, and industrial production, while agricultural products like wheat, corn, and coffee are staples that impact global food markets. These commodities are vital to both developed and developing economies, influencing everything from technology development to food security. The trading of these commodities happens through spot markets, futures contracts, and exchange-traded products. Silver and copper, for instance, are heavily traded in futures markets as investors and industries seek to hedge against price volatility. Natural gas futures are critical for energy companies and investors looking to manage price risks. Agricultural commodities are particularly sensitive to factors like weather conditions, which can drastically affect crop yields. Similarly, the prices of metals like copper and silver are influenced by technological advancements and industrial demand, especially in the growing sectors of renewable energy and electric vehicles. These commodities, though diverse, are interconnected, and their prices often reflect broader economic, environmental, and technological trends. Commodity trading offers the potential for high rewards, largely due to the inherent volatility and leverage available in these markets. Prices of commodities like oil, gold, and agricultural products can fluctuate significantly in short periods, providing opportunities for traders to profit from price swings. Leverage, which allows traders to control large positions with a smaller initial investment, amplifies potential returns. For experienced traders who can accurately anticipate market movements, this volatility can lead to substantial gains, especially when factors like geopolitical events, supply disruptions, or seasonal changes dramatically shift prices. However, with high rewards come significant risks. Commodity prices are notoriously volatile, and they can be influenced by a wide range of factors, including geopolitical tensions, natural disasters, changes in supply and demand, and even shifts in government policies. For instance, a hurricane can disrupt oil production, causing prices to spike, or a bumper crop can lead to an oversupply of wheat, driving prices down. These unpredictable events make commodity markets riskier than many other asset classes. Successful traders must understand market dynamics, use technical analysis, and stay up to date with global news to make informed decisions. Without these tools, the risks of losing money can be as high as the potential rewards in the world of commodity trading. Getting started in commodity trading offers several investment options, each with its own approach and level of involvement. One of the most direct ways to invest in commodities is by purchasing physical assets, such as buying gold or silver bullion. However, most investors opt for more accessible and flexible methods like trading futures contracts, which allow them to speculate on the future prices of commodities without physically owning the assets. Another popular option is investing in exchange-traded funds, ETFs, that track the performance of commodities like oil or agricultural products. For those looking for indirect exposure, investing in commodity-related stocks such as oil companies or mining corporations provides a way to benefit from commodity price movements through equities. Today, numerous online brokers and trading platforms make it easier than ever to participate in commodity markets. Well-established platforms such as E-Trade, TD Ameritrade, and Interactive Brokers offer a range of tools for trading commodities, from futures contracts to ETFs. For beginners, it's essential to approach commodity trading cautiously. Starting small, diversifying investments across different commodities, and keeping up to date with market trends and global events are all critical steps. New traders should also focus on education and market research, as understanding the factors that drive commodity prices is key to making informed and profitable trades. In conclusion, commodity trading encompasses a dynamic and crucial aspect of the global economy, with commodities like gold, oil, and agricultural products playing significant roles in various industries. We've explored the different methods of trading commodities, including direct investments, futures contracts, and ETFs, along with the risks and rewards that come with participating in these markets. The volatility of commodity prices offers both opportunities for profit and challenges that traders must navigate carefully. Understanding the driving factors behind price movements is essential for success in this arena. The importance of commodities cannot be overstated, as they serve as fundamental resources that impact everything from energy production to food supply. For those considering diversification in their investment portfolios, commodities present a valuable opportunity. We encourage you to conduct further research and explore how commodities can enhance your financial strategy. By integrating commodities into your investment mix, you can better position yourself to navigate market fluctuations and seize potential growth opportunities. If you found this video helpful, don't forget to give it a thumbs up. Subscribe to our channel for more insightful content and hit that notification bell so you never miss an update. Thanks again for watching, and I'll catch you in the next video.